Here is what nobody is connecting right now. Iran just rewired global oil payments through Bitcoin. Morgan Stanley just handed 16,000 advisors a Bitcoin product. And Washington just dropped a report that could permanently reshape how Americans earn yield on digital dollars. 3 separate headlines. One undeniable conclusion. The institutions are not coming. They are already here. And if you are holding Bitcoin right now, you are sitting exactly where the smart money has been quietly positioning for months. Let us start with the headline that most people skimmed past without understanding what it actually means. Iran controls the Strait of Hormuz. Roughly 20% of the world's oil supply moves through that narrow corridor every single day. And Iran has now moved to require Bitcoin or stablecoin payments for transit tolls, $1 per barrel. For the largest supertankers, that figure rises to $2 million per crossing. Think about what that actually demands from every shipping company on Earth that needs that route. They now need a functioning crypto wallet. They need the ability to acquire and move Bitcoin or stablecoins on demand. This is not a headline about Iran. This is a headline about forced Bitcoin infrastructure adoption at the level of global energy trade. Here's the angle you have not heard anywhere else. The Strait of Hormuz processes roughly 17 million barrels of oil per day. If even half of those barrels move through toll-paying vessels, that is $8.5 million in Bitcoin, demand generated every single day just from Iranian transit fees. Not from ETFs, not from retail investors, from oil, from the physical backbone of the global economy. That math has not been run publicly anywhere. Run it yourself and tell me Bitcoin adoption is slowing down. Now here is the critical context that makes this moment even bigger than most people realize. Since 2020, over 50 countries have expanded Bitcoin access regulation and legal clarity. 34 countries have approved a Bitcoin ETF or exchange-traded product. The United States allowed banks to custody Bitcoin directly for the first time in 2025. Bolivia legalized Bitcoin in 2024. Argentina legalized Bitcoin payments in 2023. The Czech Republic removed long-term capital gains tax on Bitcoin in 2025. Russia legalized Bitcoin mining and its use in international payments in 2024. Hong Kong approved Bitcoin ETFs in 2025. Only 4 countries in 6 years moved in the opposite direction, 4 out of 50 plus. The trend is not ambiguous. The trend is historic. And yet somehow the mainstream narrative still treats Bitcoin like a speculative bet. Let me show you why that framing is about to collapse permanently. Let us talk about Morgan Stanley because this is the story that the financial media covered, but almost nobody fully unpacked. Morgan Stanley just launched a Bitcoin ETF with the lowest fees in the entire market, lower than BlackRock's IBIT, lower than every competitor. And they have 16,000 financial advisors attached to $7.4 trillion in client assets. BlackRock's Bitcoin ETF hit $100 billion in assets under management in just 435 days. That was before Morgan Stanley flipped the switch on their advisor network, before their wealth management machine had a vertically integrated Bitcoin product to push. Now they do. Here is the original insight that connects this to something much larger. When a firm like Morgan Stanley prices their ETF below BlackRock, they are not competing for the fee revenue. They are competing for the relationship. A Morgan Stanley advisor pitching a sub-fee Bitcoin product to a high-net-worth client does not have to defend a conflict of interest. There is no fat margin making the advisor look self-serving. The pitch becomes clean. The trust barrier drops. And that is exactly how you move $7.4 trillion. Not with hype, with optics and incentives aligned perfectly. There are reports from inside Morgan Stanley that their advisors spent the better part of a year being educated on Bitcoin before this product launched. That is not coincidence. That is orchestration. While retail investors were debating whether Bitcoin was in a bubble, Morgan Stanley was quietly preparing their entire advisory force to have the conversation. The product launch was not the beginning of that story. It was the conclusion of a long internal strategy that most people never saw coming. Now here is where the stablecoin story locks into all of this, and I want you to pay very close attention, because this is the piece that will determine how fast the next wave of institutional capital moves. The White House Council of Economic Advisors just released a 20-page report. The title is The Effects of Stablecoin Yield Prohibition on Bank Lending. Here is the core finding. Banning yield on stablecoins would cost American consumers $800 million in lost earnings. In exchange for that cost, the banking system would gain only $2.1 billion in additional lending capacity. That is 0.02% of the total U.S. loan market. The cost-benefit ratio is 6.6 to 1 against the ban, meaning for every dollar of benefit to banks from restricting stablecoin yield, American consumers lose $6.60. The White House is not releasing that report by accident. That report is a political instrument. It is telling Congress that if they vote to ban stablecoin yield, they are voting to take money out of ordinary Americans' pockets for the benefit of banks. And Patrick Wyatt from the White House Crypto Council confirmed this report was requested back in January and used to privately brief key senators weeks before it went public. The compromise language on stablecoin yield in the current legislation moved in a more favorable direction. That report helped move it there. Now let me give you the connection that I have not seen a single major channel draw yet, and this is the one that should make every Bitcoin holder sit up straight. Here is what is happening simultaneously in 3 separate arenas. Iran is forcing Bitcoin infrastructure into the physical oil economy. Morgan Stanley is routing trillions in legacy wealth into Bitcoin through a low-friction, low-fee product designed to remove every psychological barrier to entry. And Washington is officially on record arguing that restricting crypto yield harms consumers. 3 arenas: physical economy, legacy finance, federal policy, all moving in the same direction at the same time. That is not a coincidence. That is convergence. And convergence at this scale does not reverse. It accelerates. Let me give you one more piece of original math that connects the macro picture. The United States national debt currently sits above $35 trillion. The interest payments alone are consuming a larger share of the federal budget than at any point in modern history. Multiple analysts at the intersection of sovereign debt and digital assets have noted that a country holding a significant Bitcoin treasury position benefits from Bitcoin price appreciation in a way that partially offsets debt service pressure. If the U.S. government were to accumulate even 1% of Bitcoin's total supply at current valuations, that position would grow with price. And at a price target of $500,000 per Bitcoin, 1% of total supply becomes a multi-hundred billion dollar strategic asset on the national balance sheet. This is not fantasy. This is the same logic behind gold reserves, the same logic behind strategic petroleum reserves. Store value in an appreciating asset to hedge against the depreciation of your own currency. Bitcoin is the only asset on Earth that is simultaneously decentralized, scarce, globally liquid, and now being integrated into the physical oil economy by nation states. That combination has never existed before in monetary history. Now here's what all of this means for you sitting at home watching this right now. Iran creating mandatory Bitcoin demand from oil shipping. Morgan Stanley activating 16,000 advisors against $7.4 trillion. Washington using federal economic research to defend consumer crypto rights. The Clarity Act moving closer to resolution. Bolivia, Argentina, Czech Republic, Russia, Hong Kong, all expanding Bitcoin legal status. 34 countries approving Bitcoin ETFs. U.S. banks now legally allowed to custody Bitcoin directly. These are not separate stories. They are chapters of the same book, and the book is being written faster than almost anyone has priced in. The people who will look back on this moment and feel regret are not the ones who bought and watched it dip. They are the ones who watched the convergence happening in real time and still waited for permission that was never going to come from mainstream media. The institutions did not wait. Iran did not wait. Morgan Stanley did not wait. Washington is not waiting. Here is your fortune cookie for today. The loudest skeptics of every monetary revolution in history had one thing in common. They were present for the moment. They just refused to recognize what they were watching. Do not be that person. The data is in front of you. The math is available. The institutions have already moved. The only question left is whether your portfolio reflects what you already know to be true. Stay analytical. Stay patient. Stay ahead.